today. All right. Our market master of the day is Samir Arora, a founder and fund manager at Helios Capital. Samir, great to have you with us here. Thank you very much. And congratulations from all of us on the mutual fund approval, Samir.
Yes, thank you. That's a tough approval to get, but it's still an in-principle approval. So we have to now work to get a license.
Got that. Samir, so what is what's the view now? I mean, you know, things have gotten quite a bit murky, haven't they? Especially on the global market front. And some of it is starting to get, one is feeling that here in India as well, occasionally. How are you set up?
No, actually, as I was saying, last time we met, I was checking which day was that. I think that was the day after Jackson Hole meeting, and it was very clear that we will have to give up much of the new returns that have been made from June and onwards, because the language was tough, the numbers were bad, and in general that has worked out to a point that the market is down 5-6%. But I don't understand, like today, just now when you guys were discussing, that when yesterday Nasdaq is down 2.8% and day before there's nearly maybe a very small probability that some pension fund might go under in the UK, that we are surprised that our market is not flat or it is not green. I mean, that would be unreasonable. Even if it turns out to be, then it won't last. For example, yesterday morning was the easiest money that we made in recent days, in the morning when the market is up 1%, when everybody knows that the UK has not reversed to help the market. It has reversed to avoid an utter crisis.
Absolutely.
And to take that as normal, and therefore now this means that central banks will give up and they will support the Dow, and all these stories that we are hearing makes no sense. We are in super tough times and we have to negotiate it, not by, like, we are not short of much more than what we were before, or in the PMS, Mr. Irani is not having so much cash, but mentally we should be ready to say that you have to negotiate this period without jumping in on every decimal point move here or there.
Oh, no, absolutely. Samir, good morning. Yesterday was, and we spoke about it as well, that perhaps the would be absolutely short-lived. The point is maybe this morning, because of the strength in currency and in general, some of the other markets showing a bit of a risk on, maybe things would have been slightly better. And given that we are heading into policy, Samir, what's your view on how rates are headed? Because that's an important factor for equity market valuations.
Correct. So first of all, that today I don't think that everybody's saying they do 50 basis points, but they can't act dovish, because till the US guys act a little bit that their job is done. That's why we say, and I've been saying it for so many years, but the way our markets work is, if you read a book, you will not care for that book because you say, I have not lived through it, so I must live through it. Nobody wants to learn. But I've been saying forever, we cannot be so disconnected. I lost so much money and performance in 2008 because I defended everything saying not connected to me. It was connected to me in some sense. Today, what is connected to us is interest rates, number one. It is connected, and that's why you see how many $1 billion have gone out because of currency, which is related to interest rate differentials, inflation, whatever led maybe. Secondly, we are connected because our exports in many things are related to what is happening to the US corporate sector. Yesterday, Nike said a little bit that my numbers are a little less, and their stock price fell, I think in aftermarket has fallen 10%. But does anybody believe that tomorrow morning their tech business, tech revenue will not be, tech budget will not be reduced by maybe 1% or 5%? All these guys would be losing on their dollar revenues if they're MNCs, because most of them are, because now everything for them will be denominated in dollars and they will have massive FX currency related shortfalls in profits and revenue. And thirdly, we are all part of equity markets. So we are different, we are outperforming, but we cannot be massively outperforming in short periods of time. In long periods of time, we can outperform massively, as we have done. Yesterday, I saw a report from Morgan Stanley that since 1992, when MSCI included China in their emerging market index, the Chinese market is down and India is up some, I think, 7% per annum or something like that in dollar terms. So you outperform massively over time. But it should not be in your face every day. But that then upsets the other guys who are not there. And we should just play it cool, just not every day outperform. That's what I think.
I guess the downfall began when people started using the word decoupling, right? Till then, everything was fine.
Absolutely. We will never be decoupled is my new thing. We can be remotely coupled or something. Or distantly coupled.
We can be detached, but not decoupled.
Detached. That's a good word.
And Samir, I remember you had said in 2008 that was the one big lesson that you had learned, that you thought that
Correct.
we are God's gift to mankind. We are not like any other country, right? Yeah. Okay.
Is that, by the way, is that a red bull behind you?
Yes, that's a bull.
Okay.
You want to see I could turn around? It's a massive bull.
Shouldn't it be green? I mean, oh wow, that's a pretty big, that's a pretty big bull. Okay, but there's conflicting signals there, right? I mean,
Red Bull.
it's a red bull. It should be a green bull.
Market needs a Red Bull. Market needs Red Bull now.
Does the market need a red bull? All right. Well, Samir, the other thing, I don't know if it matters in the larger scheme of things, but I was reading this piece, and all of us, of course, covered it as well, about how financial savings in India have gone up. Financialization of savings has gone up substantially, right? I mean, the mutual fund shares in household savings has jumped 150% in FY22. Do you think that the retail money that's coming in, do you think that could sort of keep this market outperforming the rest of the globe? Is that the right way to look at it, or is it too simplistic?
So that is what is helping. And by the way, we totally are subscribers to this theory, and hence our investments, because there'll be big investments in the mutual fund business in India, is because the Indian market, which for many years we took it, like more than 15 years, only as a source of investing and raise money from outside. And over the last 6-7 years, it has also come into sort of a maturity where it has become a good market to raise money. So yes, definitely. And that is obviously one big reason why the market has outperformed, because we were able to handle very massive selling by FIIs. And obviously when the FIIs come back, then it will be very difficult for them to not make a big price impact, because if the Indian mutual funds or retail or whoever or PMS, whoever has bought it at the time when those guys were selling, they are not going to give it back to them so easily. So that part is all agreed. I just feel that currently the uncertainty on many things now, which is US interest rates, which is UK trying to do a suicide policies, or Russia, or heightened discussions on these things, or exploding of that pipeline. All these things mean that for the next 2-3 months, we should not be taking everything as an opportunity to invest the last dollar. We are anyway invested 90% say in a long only fund. It is just that the way you think of it every day is the only difference. It really doesn't matter so much on what action you take, but it's a psychological thing that you are not thinking that, oh, if it is up 10 basis points, I'm missing the market or something. I think you should take the end of till the rest of the year off, and then we start in Jan after these events have mostly played out in US, because they will. It's not that I am making this random timetable. It is the timetable in which there are 2 big interest rate hikes still to come, 2-3 more inflation numbers, and everything will play out one way or the other. Now, whether you invest the last 5% now or after 3 months, it is more a way of handling the market psychologically more than what it will mean financially.
Big trade in the market this year has been to buy banks and sell IT. Do you think that trade will continue?
It is continuing. We did it later in the year, but as I told you last time also, which was in August, and we have zero IT for the first time in our life. Now, my bet is not that IT, whether it goes up or down, but that it is unlikely to outperform for next even 6-12 months, because I saw this again in 2000. That the managements of the companies have no idea beyond seeing the next 3 weeks or 4 weeks. And the best summary of that is that I think on 19th of September this year, which is a few days ago, there's a report which you must have got from Credit Lyonnais recommending IT stocks and saying that the management of the companies they met said they have high visibility for the first 2 quarters of FY23, which is ending today. So a report which was published on 19th of September basically was saying that the managements have visibility for 11 more days. I don't think anybody knows these things. That's what I'm saying. If Nike yesterday has that result and the stock falls 10%, you can take it from me that some budgets will be cut somewhere and other MNCs will see. And point is, it cannot easily outperform. It may perform. It may even outperform a few percent, but it's not going to pain me for taking that trade now. We are already in the money because we did it a few months ago or a few weeks ago, maybe 7-8 weeks ago. And we are going to do it for now. I mean, keep it. It's not that we kept cash, so we, with that money, bought financials and consumer, and hopefully at least 6-12 months we can outperform with that.
Samir, the point about taking the rest of the year off, a globe-trotting fund manager like you can afford to do that. Us mere mortals, not so much.
Mentally means, as I said, not to get excited with yesterday's move. Although yesterday I got excited and we sold 4% shorts and random money we made. It was just a gift for.
So there's a term for that, right, Samir? It's called quiet quitting, right? Where you mentally take off from work, but you still physically land up at your job. And that's what Samir's planning to do.
That's an interesting one, Sonia. Now, yeah, Samir. So the other area which you've not been terribly excited about has been autos, right? You've been kind of saying that, well, things are exaggerated and there's too much disruption and too much. Things are in a state of flux. You maintain that view? Any additional insights there?
No additional insights. Big picture. And yesterday, if you saw the auto guys in the US all down between 5 and 10%, at least that's what I saw in the morning. I don't know how they ended. But generally, I think it's the same, because the thing is, we have seen this movie a few times, that wherever there was this compressed demand, or pent-up demand in anything, whether it was TV, fridge, AC, or it was anything, it just moved after 6 months of that. And auto, because it started late in terms of, because of not getting semiconductor or whatever, or maybe people thinking whether they should have EV cars or not or whatever, it has just been a little late in the cycle. It's exactly the same thing. It is all pent up, because you're not producing enough, so it looks a big shortfall, but otherwise it's just normal numbers. I think overall auto sales might be, lower than 19 even now. So what is the big deal in this?
So there's one theme that's playing out, right, across the globe, which is this Europe plus one theme. And we are seeing it in the specialty chemical, in the fluorination players, SRF, Gujarat Fluoro. Your thoughts on whether those will continue to outperform?
No, that I think is right, because previously the China plus one was working in Europe one, but Europe plus one has some small confusion because many of them are customers, and and also Europe in the middle of this has to, its own demand might come down. But overall, in a big picture sense, I think China plus one and Europe plus one are going to play out in nearly everything. If you look at even the costs in Europe, the demographics in Europe, and now gas prices or whatever else, and security, and so I think that way I'm very bullish on India, and I think, by the way, just to tell you, we mean the market is bullish on India because now we are doing A and we are doing GST and we have got collections and we have infra, whatever. But for the last 25 and 30 years, India has beaten nearly every market in the world, including US, Europe, Japan, China, Asia ex-Japan, Asia ex-emerging markets. Maybe some smaller countries here or there might have done well, but we are not in the top. We are number one. I mean, not in the top 5, top 3. It's number 1, literally. So the market in India is very good. And if it is getting some of this tailwind, then it just makes it easier. Plus, we have another tailwind now, which is that there is a domestic buyer market.
Absolutely.
So that helps in a bad time also. And
this outperformance you refer to is in dollar terms, Samir?
Yes, in dollar terms. That's dollar terms, of course.
Okay, but
for 25 years, the Indian market, I just did it till August 1997 to August 2022. The Indian market has beaten Warren Buffett, that is the NSE 500 in dollar, has beaten Buffett by 1.1% per annum, and Buffett himself has beaten S&P by 0.9% per annum. So we have beaten the S&P 500 in dollar terms by 2% per annum. So next time, when you are going past the NSE building in BKC, please take a selfie with the building also.
Got that. Good that you said that, because when I put it, I was trolled a bit, but that we have been resilient and our market has been strong.
Black and white.
Yeah, absolutely. Last question. So before we let you go, Samir, while you're bullish on India, given what's happening in the US, do you get a bad feeling about the US market, because it will have impact, right? The kind of 2007-8 phase, is that a possibility, or I think that's too alarmist?
That is too alarmist. So my thinking has been that all the events that are playing out are mostly going to play out in this quarter. As in, now there are 2 more hikes, and if, let us say, currently somebody saying it's 50 basis point and another 50, or it might be 75 and 50, but along with the commentary and 3 more numbers, most probably it would have played itself out. And also, if you look at the duration of these bear markets, if you can type on Google and see duration of US bear market, or you can type and see extent of fall in various bear markets, and you will see the whole table says from 1929. Broadly speaking, the average comes out to around 30-odd%, 32%, and you can play and say, I don't want the 29 number because it was a global recession and whatever. Or you can see the duration is approximately 300 days. So generally it will fall in line. And I think Indian market will go up in absolute when the US market stops falling, or you stop expecting it to fall every day.
So we're close to price-wise bottom, you feel? Maybe there will be some more time consolidation.
Yeah, I don't think, by the way, the US market will go up a lot next year.
Okay.
Because if you see the previous bear markets, and when they have these sharp reversals, those sharp reversals happen because that day suddenly the Federal Reserve, in an attempt to stop that bear market from happening, from worsening, suddenly says massive interest rate cut or liquidity injection, or at that point, because of some crisis, the valuations have become very cheap. Here, I think it will stop falling and maybe plus minus will go up. But then India can outperform and make 15-20%. Right now, our outperformance is that we have not fallen. And in dollar terms, we have still fallen reasonably, like 12% or something year to date.
Oh no, or valuation, Samir, but the premium is at record high for Indian market compared to the emerging market peers, right? That doesn't worry you?
No, it doesn't worry me, because first I say to any of these foreign investors who says that the valuation is high, is that our market is down this year or maybe flat this year. So it's not our fault that our valuations have gone up. It has not gone up because our earnings fell and therefore the valuation became high. It has become high because these other countries did badly. And they did badly for a reason which you can see. It's not that they have randomly fallen while you were running a marathon and somebody got left behind, but somebody broke his bone or somebody had a serious crisis. What can we do about him losing the race? So if you believe that Europe has a problem, then it has become cheaper, but maybe it hasn't become cheaper because maybe the earnings will fall much more and will turn out to be actually more expensive. And China, take the reasons. If you accept those reasons, then you can say it is cheap. Otherwise, you can easily turn around and say that this was not the way you expect to invest in a country where policies can be reversed for some larger good and whatever, and 2 days after listing you can reverse things like they did for Didi or that, whatever. So the point is, it has not happened because generally all markets were going up and then we went up a lot more and therefore became expensive. No, we have also not gone up, and they have their own specific micro issues. If you accept them, okay, they are cheaper, but it's not random that it's happened. It's happened for a reason. It's like saying that one company is doing very badly and the fellow has run away to London and we said become very cheap. But it's become cheap because there's a corporate governance issue, and therefore if you want to deal with it, yes, it is cheap, but for most people it is not a fair comparison with somebody else doing reasonably okay.
All right, Samir, always good talking to you. Thanks a lot for joining us.
Thank you.
That's the word from Samir Arora. The market, by the way, has taken a bit of a turn, the mid-cap side in particular. The advanced decline, Sonia, has now moved decisively in favor of the declines.
Okay, so let's see ahead of the RBI policy. The market is a bit jittery. But moving on, the IRDAI is mulling general insurers to offer long-term policies in motor, health and property. Sources suggest that the regulator has formed a working group to discuss the same. To understand how this proposal will impact the business, Anand Roy, the managing director at Star Health and Allied Insurance, joins us now. Anand, thanks for waiting by patiently. This is Sonia here. if the long-term policies were to be offered in, say, health, how will the underwriting work for this, and what's your own view on how this could pan out?
Good morning. Thanks for having me.